All right, let's just jump right in. Have you ever seen one of those headlines, screaming about the stock market hitting some new all-time high, and then you look at your own bank account and think, wait a second, something doesn't add up here. Well, today, that's exactly what we're going to unpack. That super confusing and honestly often frustrating disconnect between a soaring stock market and the economic reality that most of us are living every single day.
And this is the paradox in a nutshell, right? On one side, you've got the news celebrating that Wall Street is just booming. But on the other side, there's the reality for millions of people. Wages feel like they're stuck in neutral. Maybe a local business just shut down. It can feel like we're talking about two completely different planets.
So the big question is, what gives? How can this be? How can one major scorecard for the economy look so fantastic while so many other parts of it feel, well, stuck? That is exactly what we are going to get to the bottom of right now. We're going to start by taking on a really common assumption, one that we hear so often, it's basically treated like a fact. The idea that what's good for the stock market is automatically good for the country as a whole. For today, we're going to treat this as a myth, and we're going to investigate why it might not be the whole story. So here's our game plan. We'll start by taking apart that big myth. Then we're going to get into the nuts and bolts of how the market machine actually works. After that, we'll explore the wild world of how human stories can actually set the price of a stock. We'll uncover a major, game-changing shift in how companies think, and finally, we'll figure out how to read this scoreboard the right way.
All right, let's start with the absolute fundamentals. I mean, to really get this disconnect, we first have to be on the same page about what the stock market even is and how this whole machine is put together.
At its very heart, the market is all about these things right here: shares. Just think of a big company like it's a giant pizza. A share is just one tiny little slice. When you buy a share, you literally own a piece of that company, and you can sell that piece to someone else, hopefully for more than you paid for it.
So how do those slices of pizza, those shares, get out into the world in the first place? Well, a lot of the time, it's through something called an IPO, or initial public offering. This is the moment a private company decides to go public by selling its very first batch of shares. And why did they do it? To raise a ton of cash that they can then use to grow, build new factories, hire more people, invent new stuff. Now, with thousands of different companies out there, it's impossible to track them all. So we use tools called indexes to get a quick snapshot of which way the market is generally heading. The big one you always hear about is the S&P 500. It just tracks 500 of the biggest US companies and boils all their performance down into one easy-to-follow number. It's super useful, but you gotta remember, it's just a snapshot, a simplification.
Okay, so we've got the basic mechanics down, but here comes reality check number one. The stock market isn't just some cold, calculating machine running on pure logic. Nope, stock prices are driven just as much by belief, by emotion, and by really compelling stories as they are by any hard data. The famous economist John Maynard Keynes had this fantastic way of describing it. He said, "The stock market is like a beauty contest, but here's the twist. The goal isn't to pick the contestant you personally find the most beautiful. The goal is to pick the contestant you think everyone else is going to vote for. It's a game of guessing what other people are thinking." And this focus on psychology, on what the crowd is thinking, is what can lead to market bubbles. It starts with a really compelling news story. Think about the internet back in the late 90s. The excitement just builds, and pretty soon, people's expectations get way ahead of reality. Prices inflate way beyond any logical value, until finally that belief cracks. And when it does, the bubble bursts, and that causes very real damage to people's jobs and their life savings. This brings us right to the absolute core of our explanation today. Because to really truly understand the disconnect we see, you have to look at a huge shift in business philosophy, a fundamental change in the rules of the game that decided to put one group of people above everyone else. The crucial moment happens back in the 1970s. It's an idea championed by the economist Milton Friedman, and it's called shareholder primacy. And the idea is really simple and really powerful. It says that the one and only social responsibility of a business is to make as much money as possible for its shareholders, the people who own the stock, period. And wow, the consequences of that shift in thinking are just stark. As the main goal became maximizing shareholder value, executive pay got tied more and more to how well the company's stock was doing. The result? This dramatic, almost unbelievable explosion in the gap between what a CEO makes and what their average worker earns. So this new game created a whole new set of incentives. Over on the left, you've got the stuff that builds a strong, healthy company for the long run, investing in research and development, paying your workers good wages, training them. But on the right, those are the things that can give the stock price a quick short-term sugar rush, cutting costs, laying people off, or using company cash to buy back your own stock. Can you guess which path started to look a lot more attractive? And listen, this isn't just some abstract theory. This stuff has real-world consequences. Take the case of Wissal Paper. The company got intense pressure from so-called activist investors to deliver immediate returns to shareholders. This led to a focus on cost-cutting and payouts instead of investing in the future, and it ended with a plant closing down, which completely devastated the local community. That's the human cost of this short-term thinking.
So we've seen how the machine works, and we've seen how the incentives got twisted over time. Let's pull it all together in our final section and figure out how to read this scoreboard correctly and, most importantly, what it all means for you. Okay, if you only take one thing away from our time together today, let it be this. The stock market is a scoreboard, for sure, but it's only scoring one part of the game, the perceived future value of large publicly traded companies. It is not, and it was never designed to be, a complete report card on jobs, on wages, on small business health, or the overall well-being of the nation.
So what can you actually do with all this information? Well, you have a few tools. As an investor, the legendary Warren Buffett has long said that for most regular people, simple, low-cost index funds are a really smart way to go. As a shareholder, and yeah, that counts, even if it's just through your retirement fund, you actually have the power to vote. And as a citizen, you can be a voice in the larger conversation, pushing for policies that reward long-term strategy over short-term gains.
So in the end, yeah, the stock market is a powerful machine and a very, very loud scoreboard. Understanding its rules and its incentives helps you see the numbers for what they are without ever confusing them for the whole economic picture, which really just leaves us with one final big question. The market is a powerful scoreboard, but are we watching the right game?